Scott Bessant is back in the headlines, and the pressure is clearly mounting, despite his best efforts to appear composed. This isn't just another routine appearance at the podium. It's a high-stakes performance aimed at preserving the fragile narrative that a breakthrough trade deal with China isn't just possible, it's imminent. Bent is selling a message that everything is on track, progress is real, and the U.S. economy is about to turn a corner. But behind that calm front is a frantic effort to convince investors, businesses, and ordinary Americans that the deal will come through. Because, frankly, it has to. The U.S. economy is leaning heavily on this promise. Bent insists that discussions with China are in a strong position ahead of a critical meeting in the coming weeks. But let's not kid ourselves. When have U.S.China trade talks ever been straightforward or smooth? These negotiations are always complex, high-level games of strategy, each side calculating every move, seeking leverage, and determined not to give away even the smallest symbolic win. Realistically, there's a strong chance that Trump will have to extend the deadline yet again. If that happens, it plays directly into China's hands. It signals weakness, undermines Bent's assurances, and erodes the U.S.'s negotiating power in real terms. Meanwhile, the economic pressure is growing. The U.S. is already grappling with a mounting wall of tariffs on essential inputs, copper, aluminum, and steel. These aren't luxury items. They're foundational materials for American manufacturing, and the tariffs are taking a toll. The damage is not theoretical. It's real, and it's happening now. The numbers tell the story. Manufacturing is contracting. Factory jobs are plummeting, with May's employment figures revealing just 280,000 workers in the sector, an 8-year low. And it's not just employment. Domestic consumption is down. Exports are dropping. That 1-2 punch is deadly for any economy. This is why Bent is under such pressure to prevent a breakdown in the talks. It's not just about cheap toys or furniture. These are intermediate goods, semiconductors, metal parts, chemicals, key components U.S. companies need to produce and deliver finished products. If talks collapse or tensions worsen, inflation could rise again, especially in core sectors. U.S. manufacturers will feel an even tighter squeeze. Contracts may be delayed or canceled. Layoffs could escalate. Markets will react brutally. Stocks will fall. Bonds will be hit. The ripple effects will be far-reaching. When Bessant walks into that room with the Chinese delegation, perhaps alongside Hurley Fun or even Lutnick, the stakes couldn't be higher. Every statement will be carefully weighed. Every promise examined. In a recent Bloomberg interview, Bent tried to paint a positive picture, claiming U.S. equities are rising thanks to Trump's trade acumen. The message is clear. The deals are working. They're delivering results. But that narrative only holds if the China deal survives. If it fails, optimism evaporates, and the markets will respond with harsh realism. Let's not forget what the U.S. imports from China. It's not just consumer goods. It's high-value categories: computers, electronics, machinery, chemicals, industrial metals. Over 60% of imports fall into sectors vital to industrial production and daily consumption. If the deal falls apart and tariffs continue or expand, prices will rise, not just in stores, but throughout the production chain. U.S. companies will struggle to remain competitive. That's how you end up in a perfect storm: rising inflation, falling output, and financial instability. A critical problem here is supply chains. The U.S. never developed strong alternative sourcing networks. Over 2 decades, there was no serious push to diversify through Latin America, Africa, Southeast Asia, or even with resource-rich partners like Russia. Now, U.S. production can't meet demand, and tariffs of 30% to 50% are hitting goods we still desperately need. Yet Lutnick and others continue defending tariffs under the banner of national security. The U.S. is trying to corner China into a deal, but 2 massive challenges stand in the way. First, China's exports remain strong. Despite tariffs, global demand hasn't disappeared. They've found workarounds. Second, and more crucially, China hasn't even activated its biggest internal strength, domestic consumption. It remains largely untapped. But if Beijing decides to stimulate internal demand, the balance shifts dramatically. China's GDP deflator has been negative for 9 straight quarters, meaning prices are low. That's bad for corporate margins, but good for consumers. If the government injects stimulus and narrows the gap between retail sales for 0.8% and industrial output 6.8%, the U.S. loses leverage. The entire dynamic flips. Bent is left negotiating from weakness. What gives China this edge is the resilience of its export-driven manufacturing base. It provides flexibility, global influence, and a buffer in turbulent times. China can support allies. It can absorb shocks. That's why more countries are drifting toward Beijing. Take Indonesia. They recently signed a deal with the U.S., lopsided in every sense. They agreed to buy $15 billion in U.S. energy, $4.5 billion in food, and 50 Boeing jets, all for a tariff cut from 32% to just 19%. That's still steep. And U.S. exports? They face little to no matching tariffs. So what does Indonesia do? They lean back toward China, importing more to lower production costs and fight inflation. And that, in a nutshell, is how this ends. China negotiations are heading toward one of two outcomes. Another temporary stalemate where Trump kicks the can further down the road, or a moment where China capitalizes, strengthening its global position even more. Looming in the background of all this is a much bigger shift, the future of the U.S. dollar. Speculation is growing around who will replace Jerome Powell as Fed chair. And it's virtually guaranteed, by May 2026, he'll be out. That gives Trump a window to install a loyalist, someone aligned with his vision. We all know what that likely means. The next Fed could aggressively slash interest rates, possibly down to 1% or even lower, ushering in an entirely new era of monetary policy. Whether that becomes a much-needed stimulus or a signal of financial desperation depends entirely on how China relations unfold in the coming months. Here's what no one's saying out loud. Every serious candidate to replace Powell, Hassett, Waller, Bent, even Kevin leans dovish. Once one of them takes the chair, rates are coming down hard and fast. That might sound great at first, but it triggers a chain reaction, one that could drive the U.S. dollar into a steep decline. Add in the ongoing trade war, and the outlook becomes even bleaker. You can't expect a currency rebound when international trade is weakening and the central bank is preparing to flood the system with liquidity. Two forces typically hold up the dollar's strength: a healthy trade balance and strong foreign demand for U.S. debt. Both are faltering. Start with the trade deficit. It's worsening. Imports are down, but not for good reasons. Tariffs are the culprit. And U.S. exports are also falling. In May alone, the trade deficit hit nearly $100 billion, a 10% spike from April. That kind of increase puts serious downward pressure on the dollar. Then there's demand for U.S. treasuries. For decades, it's been a major pillar supporting the dollar. But with the currency already weakening and the likelihood of lower yields under a dovish Fed, that demand is becoming less reliable. Lower yields mean lower returns for investors. Combine that with rising inflation expectations, and U.S. bonds start to look far less attractive. If Trump replaces Powell with someone who cuts rates aggressively, yields, especially on the short end, will drop. And that's hardly a magnet for global capital. All signs point to a sobering reality. The dollar's decline may be far from over. We could be at the edge of a deeper structural shift, one that rewrites how global trade and currency flows operate. And unless the U.S. radically changes course on trade policy, this trajectory may continue. Before 2025, global markets followed a clear pattern. When international stocks rose, the dollar fell. When those stocks crashed, the dollar rallied as a safe haven. But now that logic is breaking down. In March and April, global equities were falling, and so was the dollar. That's not supposed to happen. This shift signals a major disruption. It confirms what many feared: U.S. policy is breaking the playbook. The dollar no longer acts like a reliable hedge. It's being dragged down by domestic policy decisions. And this goes beyond economics. It's about global realignment. Countries are watching, and they're adjusting. Take Australia. They've re-entered deep trade negotiations with China. Prime Minister Albanese even visited Beijing, walking the Great Wall, a symbolic move with real-world implications. After years of diplomatic tension, the frost is thawing fast. Why? Because survival and strategy always beat pride in politics. China is Australia's largest trading partner by far. This isn't about photo ops. It's about securing a future. China buys huge volumes of Australian iron, or LNG, gold, and agricultural goods. And with China's middle class set to boom in the next decade, consumption will surge. Mining accounts for nearly 10% of Australia's GDP. That level of demand from China isn't just welcome, it's essential, especially now as the U.S. closes doors with protectionist trade policies. The irony is stark. Australia is spending billions on nuclear submarines from the U.S., preparing for possible conflict with China, while simultaneously working to deepen trade with Beijing to keep its economy afloat. It may seem absurd, but this is what happens when geopolitical strategy collides with economic necessity. There's a hard truth here. There are no permanent friends, only permanent interests. And here's the kicker. Australia actually runs a trade surplus with China. In 2024 alone, China's trade deficit with Australia ranged between $10 billion and $20 billion. That's hard currency flowing into the Australian economy. But even Albanese knows China is diversifying fast, investing in supply chains across Africa, Latin America, and Central Asia. That makes Australia's exports convenient, not critical. If China shifts, Australia loses. So yes, the trip to Beijing was strategic, and no, Australia won't be the last U.S. ally to pivot. Many others will follow. The old world order is fading. The global map is fragmenting into economic spheres again, and countries will go where the demand is, where the growth is. For now, that increasingly means China. And it means moving away from a U.S. that looks more unpredictable and inward-looking by the day. So where does that leave the dollar? In a precarious position. We're entering a volatile new era, one where trade wars and political reshuffling matter more than rate hikes or inflation prints. The dollar is no longer protected by default. It has to earn its strength. And if U.S. leadership continues making economically self-sabotaging moves, we may be witnessing the beginning of a long, slow decline. What do you think? Can Bessant negotiate a real breakthrough with China? Can the dollar hold its ground, or is the fall just beginning? Drop your thoughts in the comments.